You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from OptionAlpha.com, working every single week to make this the most popular podcast offered online because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So thanks so much for tuning in today. And again, we've got an awesome show for you guys. I can't believe it's already show number 10 that we've recorded, but I've actually kind of starred this one on my list here as I was kind of laying out the podcast over the next couple weeks. And this one I think is one of those ones that's a must listen to. And I don't care whether you're a new trader or even if you've been trading for 10 or 15 years. I think part of the process that we've all gone away from and then we need to get back to becoming more successful and smarter traders is having some checklists and some systems in place to keep us from bad trades and actually get us into good trades, right? Everyone's worried about making a bad trade, but we need to have something in place that filters down and helps us make smarter, more profitable, consistent trades. And I think that's what I really want to bring to you guys tonight with the show that we're doing. So we're going to answer the question and try to get a lot of information out of this podcast by going over the checklist that you should use, and particularly these 7 things you should be checking before you enter each and every single trade that you make. Now, I didn't just randomly think about 7 things, right? These things were actually things that I laid out and I said, okay, what are the bare bone but essential things that somebody needs to check before they make a trade? What do I check before I make a trade and send out an alert to our members? And I came up with 7 things that I check and kind of go through kind of in broad categories. So I'm going to go through those. And again, it's not that I just made up 7. These are really the things you should be checking. So if you don't have a pen and paper, if you can't get to a computer and listen to it, you can always check out the show notes at optionalpha.com/show10, just the number 10. We'll have all of these listed here as well as some video tutorials linking to some of the more in-depth tutorials that we have on the membership side of our blog and on the website, and going over each one of these things in the checklist. Okay, so let's get right into it tonight. We'll talk about what we're going to talk about, the 7 items. The first one that we're going to talk about tonight is portfolio fit. Then we're going to talk about liquidity, IV percentile, strategy, strikes and timeline, position size, and then finally we're going to talk about what your plan B should be. Okay, and it's going to be a little bit different than what you probably assume when somebody says, what's your plan B? But we're going to talk about a little bit different context. It might get you thinking more strategically about how you're placing trades. So the first one on our list of the things you should be checking before every trade is portfolio fit. And the reason this is first on your list is because this can actually kick out a lot of potential trades that you might be in or that you might consider making. And what portfolio fit is really asking yourself, do I need this trade in my portfolio? Right? So a classic example of this is I have this a lot with students that I coach, is that they have a lot of positions that are bullish. And so they come to our coaching session and they say, all right, well, I'm looking at this trade and it's another bullish trade. And I'm thinking to myself, well, you've already got 15 bullish trades, right? You're already directionally bullish. Do you really need another bullish trade in your portfolio? Or is this a trade that you can probably skip? And I don't care how good the trade is, right? Because I get a lot of people that say, well, Kirk, this trade's, but this is really good. Like, I really like the setup. I don't like the setup on, anything that much that I want to be chasing after, right? And I want to kind of blindly go into that trade. So the first question you should definitely ask yourself is this a good fit to your portfolio? Now, I personally like to have my portfolio generally neutral. Okay, now that doesn't mean that I'm going to be always neutral. It's okay to take some bias, whether you're, directionally long gold or silver or oil or whatever, tech or, commodities, whatever you want to be, you can have some directional bias. But what you want to do is you don't want to get too, tilted in one direction or another, or even too tilted in one sector over another. So like if you have too many positions in oil, maybe you just don't even look at any positions that could be in oil. So don't even look at any ticker symbols that could be related to oil. And again, this is why this is number 1 on the list, because this can kind of really narrow down the universe of things you should be looking for and help you save time in how you're going about and using your day to look for trades and place trades. Now, number 2 is liquidity. Now, again, this is number 2 on our list because this will also narrow the list down for you very quickly and help you save time and be more decisive with your decision making. Now, liquidity is something that is kind of fluid. No pun intended there with liquidity, because liquidity for some stocks could mean something for others, right? Now, my general rule of thumb is that I like to see at least 100,000 shares traded on the actual stock. And the reason that I like to see at least 100,000 shares traded on the actual stock is because it's got to be liquid enough that therefore the probabilities that are based off of that stock movement are going to be reliable enough. So a really good kind of black and white example of that is Apple versus a ticker symbol like GOOD, which is GOOD. And so Apple had on Friday, as I'm recording this podcast over the weekend, on Friday had 57 million shares traded of its actual stock. And GOOD only had 57,000 shares traded. So a lot less liquidity in GOOD as far as the actual underlying stock, which we're options traders, but that still is important to us as options traders. We want that stock to be very liquid. Now, when it comes to the actual underlying options, we also want those to be very liquid. And that, again, is very fluid because you can have something where it doesn't have that much liquidity, maybe 1,000 or 2,000 contracts in open interest and maybe 100 contracts per day in volume. But that's really subjective because if you don't need to trade 100 contracts, then that might fit your parameters for liquidity. So what I usually tell people to look for in liquidity is make sure that you're just not a big fish in a small pond. So if you only are trading 1 contract or 2 contracts, you don't need to find something that has crazy amounts of liquidity. Now, again, Apple's a really good example of this. It's got, in practically every strike that we're looking at for the front month, it's got almost 25 to 30,000 contracts in every single strike. We look at something else like Home Depot or Lowe's, they've got decent liquidity, about 1,000 contracts in open interest per strike. I would say obviously that Apple's way more liquid, but Home Depot is fairly liquid and it has, good market float, so you can get in and out of it fairly easy. But again, it's just you don't want to be a big fish in a small pond. I would absolutely stay away from anything that's got under 500 contracts of open interest, because at that point you just don't even know when people are going to make trades, and if you wanted to get in or out of that trade, you may have to wait a day or two to actually see that happen. And that just creates a real big problem in trading because now you're subjective to whatever anybody else in the market is doing. You can't really have good entry and exit between the contracts. So anything under 500 contracts per day is probably something that you want to stay away from. The third thing on our list is IV percentile. Now, again, the reason that this is number 3 is because once we've narrowed down the stocks that either fit our portfolio and then have good liquidity, now we have to start thinking strategically about how we're going to make the trade. So IV percentile is the first thing on our list because we want to know, is implied volatility relatively high or relatively low for that given stock? So again, we'll continue to use Apple as an example because it's a really good example. And right now, at the time of this video, Apple is trading at about $117, and its IV percentile or IV rank is 39%. So what that means is that almost 39% of the time over the last year, implied volatility is lower than where it is right now. So we can kind of turn it around and say, okay, almost 61% of the time, implied volatility is higher over the course of the year than it is right now. So what that means is that we generally have possibly a little bit of an edge to be a small buyer of option volatility because 61% of the time it's going to be higher over the course of a year than it is right now. So that allows us to then distinguish the strategy that we're going to be doing. That just knowing where implied volatility is. And again, remember, that's our edge in trading. And we did a podcast on that. I think it was show number 7 that we did, talking about that volatility, the edge that we get as traders. So once we know what that volatility factor is, then we're able to distinguish the strategy that we're going to use. So that gets us to number 4 on our list, which is actually the strategy that we're going to use. And once we know that volatility factor, that helps us narrow down the possible strategies that we're going to use. And again, let me explain why we're doing this, right? By narrowing down the possible strategies that we're going to use, that prevents us from trading strategies that don't fit the current market environment. So let me give you an example. With Apple's implied volatility at 39% right now, as far as an IV percentile rank, what that means is that generally implied volatility is going to be higher. So we would not want to be trading strategies that take advantage of a decline in volatility. That just doesn't give us any edge in the market. Instead, we want to be focusing on strategies that take advantage of a rise possibly in volatility. So that would be things like ratio spreads, directional debit spreads, a put debit spread or a call debit spread, and then also calendar spreads or diagonal spreads. Those are the types of strategies that take advantage of a rise in implied volatility, and that would position us well strategically just by knowing where implied volatility is. So now you can see this list of things that you should be checking is kind of filtering down the trades all the way till we get to the point of making a smart, profitable, high probability trade. So we talked about implied volatility and we talked about strategy. We know which direction implied volatility may or may not go, right? We have an edge someplace and we know which strategies we want to use. Now the next thing you should check are your strikes. So this is where it's, again, very subjective to where you want to place your trades. Are you going to be very conservative and place an extremely high probability trade? So you could place a trade that has a 90% chance of success or an 80% chance of success. Or you could also place trades that are a little bit more aggressive and come in a little bit closer on your strikes and maybe place a trade that has a 60% or 70% chance of success. But the whole idea here is that you're finding those strikes that work well for your portfolio. And again, this is where you also want to go back and double check and say, okay, now that I've narrowed down the strikes and the strategy, do those strikes have enough liquidity? Is the bid-ask spread, narrow enough, or are the markets too wide and there's not enough liquidity to even make this worthwhile? Okay, so if you get to this point, it's a good idea just to go back and double check that volume and liquidity just to make sure that the markets are liquid and that there's a lot of participants in the market so you can get in and out of that security very quickly if you needed to. The other thing we're going to talk about here is timeline, right? What kind of timeline should you be using for this particular strategy? So my rule of thumb is that if implied volatility is higher, we generally want to bring our timeline in. So we want to come closer to the money or closer to the actual stock price. And we want to trade the front month or even possibly the weeklies. Like an earnings trade, we would trade a weekly option maybe 6 or 5 days out. If implied volatility is lower, we generally want to give ourselves more time because we don't have as much of an edge in the market trading implied volatility from an area of low to high. So we don't have a lot of edge doing that. And that's generally where we're buying, option strategies and we're paying a debit to get into spreads. And that's not really where we make the most of our money. It's not our real edge. You can make some money doing that, but that's not where you're going to make the bulk of your money. So in those instances, you want to give yourself a little bit more time to be right. So this would be things like your ratio spreads and your debit spreads and your calendars. You generally want to trade those, over a longer time period. So maybe 1 or 2 contract months out. Okay, so good rule of thumb there. High implied volatility, you want to come in closer to the market, trade more of the front month contracts. Low implied volatility markets, you want to actually go further out in time and collect a little bit more premium, which is going to help you overall because you don't have as much of an edge with low implied volatility trades. Now, the sixth thing that we're going to talk about quite possibly could be one of the most important things that we talk about, and that's position size. So now that you've figured out everything you want to do on this trade and you've selected your strikes, your strategy, everything, now it comes down to one of the most key areas that I see investors fail at a lot, and that's position sizing. And in fact, I just received emails this week from guys that had entered trades that we had alerted people to on the membership side of our website, and they had entered trades at 20 or 30% of their account size, which we never suggest, and they just did it because they liked the trade. But I even emailed them back and said, listen, you need to close out the trade right now. Even though you're making a little bit of money or losing a little bit of money, you need to reduce your position size. So position size is extremely important. And I always tell people that my sliding scale, and I've talked about this, I believe, on show number 4 or 5 that we did, talking about position size and the casino example that we used, that your position size should be a sliding scale between 1 and at max 5% of your capital. So at no point should a position be more than 5% of your capital, because when you start investing more than that in each and every trade, the likelihood that you could truly blow up your account and lose all of your money goes up dramatically, exponentially after 5%. So it's important that you keep any trade that you do, no matter how good it looks, in that sliding scale between 1 and 5%. Now, the reason I say a sliding scale is because obviously we can make really high probability trades, and we can make trades that have a lower chance of success that are more aggressive. So if you're making a trade that's a little bit more aggressive, maybe you slide that down to maybe 1 or 2% of your portfolio. If you're making a trade that's a little bit more high probability, you can obviously slide that risk up a little bit to the 4 or 5% level, because it is a high probability trade and you can allocate more money to that trade. But super important that you grasp that concept. And I know it can be tough with small accounts, but again, we talked about this in one of the other podcast shows. The trader that actually trades less of his money and keeps more in cash statistically wins more often than if you invest aggressively. So it's actually in your best interest and more profitable for you to keep your position size small. So make sure that that's part of your checklist. Always double check and say, am I taking the appropriate risk for this trade, or am I taking too much risk? Do I need to scale back, or do I need to just not make the trade because it doesn't allow me to do the trade with my account size? I can't do the trade with my account size. I'm taking too much risk. And frankly, I'm here to tell you that's a good trade. If you don't make a trade because it's too big and it's too aggressive, that's a good trade and you can learn from that. So that's a smart trade. Don't feel bad about doing that. Now, the last thing that we're going to talk about, number 7 tonight, is plan B. And I'm not talking about plan B if the trade, goes completely, haywire and you just got to lose all your money. What's your next step? I'm talking about thinking strategically about what could happen in that trade and looking in advance for your next move. Okay, this is like in chess, right? A great chess player is always thinking a couple moves ahead. And as a trader, you need to be strategically thinking a couple moves ahead. So a great example that I can give you guys is when you're looking at an earnings trade, for example. And we talked about this in one of the webinars that we did with our premium members. If you're looking at an earnings trade, and we typically make those with weekly options, we will also double check to make sure that those same strike prices that we're using on the weekly options are also available for the monthly options. Now, most people would ask, well, why do you do that? Well, because if the trade does go wrong, we want to make sure that we can roll the trade to the monthly options at the same strike prices. If those strike prices are non-existent, then that changes the whole dynamic of what could happen if the trade does go bad. So you want to be thinking in advance and look further out in contract month and, kind of look 1 or 2 contract months out and say, if something goes wrong and I have to adjust this trade or I have to roll this trade to the next month, is there a market for this trade in the next month? And I'm here to tell you that I've gone through a lot of situations, and particularly on earnings trades, where it looks like a great trade, everything's setting up, the premium's great, the liquidity's great, but then I glance at that next contract month and there's nothing. There's no activity, the bid-ask spread is too wide, there's completely no liquidity. And that has taken me out of trades where I will not make a trade in that instance, because God forbid if something were to happen and this high probability trade that I'm making goes against me, I have no recourse for getting out of the trade or adjusting or trying to manage the risk in the trade at all. So again, in that instance, no trade is actually a good trade. So always be thinking just a couple steps ahead and kind of work through it in your mind. What would happen if the stock went down? What would be my game plan? If the stock went up against my position, what would be my game plan? And what would I need to see in the market to execute an adjustment or a hedge that I'm trying to make in that trade? Okay, so hopefully this was really, really helpful, kind of going over all of these different examples. And again, this is not a list that I just kind of, whimsically threw together. There's a logic behind it. There's a reason that we go through it in the steps that we did. And just to recap here before we get into the closing bell, again, the first thing you're going to look for is portfolio fit. Does this trade fit into the overall portfolio, or is it just another bullish trade or another bearish trade that I already have too many of? Number 2, liquidity. Is there a market for this option? Number 3, implied volatility rank or percentile, right? Knowing this then helps us determine number 4, which is, are we selecting the right strategy to fit that market environment, right? Are we making sure that we're taking advantage of a strategy that will profit from the market situation that we have, whether high implied volatility or low implied volatility? Number 5, then determining the appropriate strikes and timeline. Again, our rule of thumb is high implied volatility market. You want to come in with your strike price or with your timeline and trade front month options. Low implied volatility market, you want to go further out with your timeline and trade the back month or the second back month options to give yourself a little bit more time in the trade. Number 6, position size. Extremely key that a lot of people get this. And I see both new and very experienced traders continually miss this one aspect because they want to be really aggressive and really successful. But being successful means trading small positions in this business. And number 7, your plan B. Kind of looking ahead, thinking like a chess player, making the next 2 or 3 moves if something were to happen in either direction to make sure that there's an adequate market for you to make an adjustment or to roll a contract is key to your ability to be successful. So I hope this checklist was a really, really good, takeaway for you. And I hope you learned, a couple things from it. So before anything else, let's get into the closing bell and let's take a look at a trade that we have in GLD, which we kind of went through this checklist together.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
Okay, so in today's closing bell, again, as you guys know, with the closing bell, it's not necessarily always about what stocks are doing or what they're moving, but trying to tie in what we talked about today with some real examples of trades that we are truly making. Like, I'm putting my money where my mouth is and making these trades. These are trades that you can get, obviously, if you sign up for a membership at Option Alpha. You can see all these trades, but they're all archived, so they're all in here, and obviously this podcast will be archived. So the one that we're going to look at tonight is a trade in GLD, and we actually did a straddle in GLD. So we sold 2 options at the same strike price for the same contract month. But let's kind of go through the checklist here of how this trade set up. So GLD is generally at the end of, or possibly the end of, a downtrend. It's, gold's been hit down pretty hard and has gone from about 135 down to about 115 in the last 6 months. So it's had a real tough time. But as it's gone down, implied volatility has gone up and is currently, at the time that we made this trade, at the 100th percentile. So what does that mean? It means that at no point in the last year has implied volatility been higher than it was when we entered this trade. Now, as an options trader, again, that means that you should try to take advantage of the fact that implied volatility is high and should come down, right? That's our edge in the market, is that implied volatility is high and we're selling it at its highest point, hopefully, and it should come down. And it's not like it can't continue going up, because it definitely could continue going up, but the likelihood of it going up is very small. It's got a better chance of going down than it does of going up at this point, at 100 IV percentile. So now that we know that it's got 100 IV percentile, now that we decided what strategy fits best, well, obviously we don't want to buy options, because we're going to be buying options that are extremely expensive because volatility is expensive. So any buying option strategy is completely out of the picture. Debit spreads, ratio spreads, calendars, completely out of the picture, because you're going to be a net buyer of options and you're going to pay a huge premium just to see that premium decline. So what we decided to do is take a look at a couple different strategies. You can sell credit spreads, do an iron condor, do a strangle, which is like an iron condor without the protection of the long wings, or you could do a straddle, which is a little bit more aggressive type of a strangle because you're selling options very close to the money. What we decided to do in this case is to do that straddle, because at this point, implied volatility is so rich, we wanted to take advantage of it with the most pure strategy that we could, and that is a straddle. It's purely selling volatility to be short naked options on both sides of the market. Now, GLD is a very high profile, very liquid ETF. And in fact, the day that we traded it had about 7 million shares traded in the actual underlying ETF. And the option positions that we were in had about 14 to 15,000 contracts of open interest. So again, extremely liquid, very tight market. So it fit all the liquidity requirements that we have. Now, what we decided to do was, again, with the straddle, do our strikes right at the money. So we did the 114 straddle, and GLD was trading around 114.5 when we actually entered this trade. Now, our timeline was the front contract month. So that was, at the time of this recording, the December options, which had about 28 days to go. So we did the front contract month, as we talked about kind of in those quick tips in the podcast today. And that's because we want to just truly take advantage of possibly a decline in volatility, which will affect those front month options quicker than a decline in volatility will affect the back month options. Now, position size, we went up a little bit more aggressive. We did this about 4% of our account size with the margin that was factored in. Obviously, straddles are going to carry a little bit heavier margin because you're short two options very close to the money, but we did this a little bit more aggressive because it is a high probability trade. These are the trades that we make money on consistently long term. Doesn't mean that we make money on everyone, but over time, this is where we actually gain our edge in the market, and this is where we generate the highest return on our capital by using these trades. So it's okay to go up just a little bit, and we did about 4% of our account balance in this GLD straddle. Now, our plan B is very simple. If GLD goes crazy and either goes up or down way past our break evens, which are far about $6 out of the money on either side, then our plan B is to just roll the contract to next month, which would be January, and extend the trading timeline. That's statistically been proven to be the best strategy. And at some point, gold is going to go higher or it's going to go lower. So we just want to see a drop in implied volatility. So the next contract month out, which is January, had about 56 days to go. Again, very good liquidity for the same strikes that we were in, about 20,000, about 30,000 contracts of open interest for the same strikes in January. So extremely high liquidity, which is great for us because if we needed to do something and make an adjustment, we know there's a market there that we can extend our trading timeline. So this was a really good trade for us. And again, you can kind of see how I kind of went down the checklist that we talked about tonight. As at the time of this recording, our GLD position is up about $120 on just a one lot that we were trading. So very nice little profit. Implied volatility has come down to 75 percentile. So it's gone from the 100th percentile now down to the 75th percentile. So we're seeing that drop in implied volatility that we wanted to see. So we're just going to wait a little bit longer and see if we can't squeeze a little bit more profit out of this trade, but we'll definitely close this one out early. We're not going to hold this thing all the way to expiration since it does carry a lot of our account balance in a margin. We definitely want to be selective with which positions that we leave on till expiration and which positions we don't. So I think this was a really good example of kind of going through that checklist. And again, this checklist is meant to be gone through top to bottom, 1 through 7, because it will help you narrow down your focus and be very strategic and decisive about the types of trades that you make.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope that you guys enjoyed today's show and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. And for me, it's all about having some sort of checklist. Whether you liked our checklist of the 7 things you should check before your next trade, whether you have your own checklist, that's 5 or 8 things. What I'm hoping to get across in this podcast is that you have to have some sort of system for filtering and picking trades. And it can't be whimsical. You can't just do it on a whim. You can't read this or read that, or even listen to us and just, always pick trades that we pick, right? The whole idea is that we're trying to teach you guys how to be smarter, more profitable traders. And it starts with creating some sort of system that you can adapt and change over time. Now, as always, you can find additional show comments, any of the links that we mentioned or videos that we talked about today by going to optionalpha.com/show10. Again, that's just the number 10, optionalpha.com/show10. And until next time, happy trading.